Good day, students. Welcome to Deferred Taxation, Chapter 6, IS 12. So, we will be covering a lot of the concepts that we learned in Chapter 5, which was in Chapter 5 we learned about how to calculate our current taxes. So, a lot of the concepts that we have learned in Chapter 5 will be incorporated into Chapter 6. Deferred taxation. So if you need to have a little bit of a refresher, because we did taxation the last week of last semester, it might be a little bit in the might be buried in the recesses of your mind. So if you need a little bit of revision, please go back to the videos and the slides that we covered in chapter 5, and you can come back to chapter 6. Okay, so deferred tax. What are we going to learn what are the objectives for this chapter? You need to understand what is deferred tax, how to account for deferred tax, the calculation of a deferred tax related to journals and disclosures, rate changes and the effects on deferred taxation, recognizing deferred taxation on assessed losses, and then calculating deferred tax on temporary differences, and then also the disclosure, right? Always disclosure and presentation. So, deferred tax. So, let's start with our total tax expense, right? So, total tax expense is presented in our statement of comprehensive income, right? And we calculate, or we get to our total tax expense figure, right, by adding our current taxation, our current tax, and our deferred tax, right? So current tax, you guys will be familiar with current tax because we covered current tax in chapter 5 last semester, right? So we have our total tax expense, and it consists of our current tax and our deferred tax. So total tax expense is tax incurred on our accounting profits, and so this total tax expense must be based or must be calculated based on IFRS, right? And then obviously IFRS involves the accrual concept. So when we calculate our total tax should represent tax incurred on accounting profits, right? And so remember, in chapter 5, when we did our current tax was calculated based on taxable profits, and we calculate our taxable profits taking into account the tax legislation. So now we can already see that there's going to be a mismatch between our total tax expense and our current tax, because it's based on two different sets of of principles, right? So remember, total tax expense is based on IFRS and our accrual concept, and we have our current tax, which is based on our taxable profit, right? So deferred tax, right, which is the other portion of our total tax expense, is it arises when we have income expenses or assets or liabilities that are treated differently under IFRS and Income Tax Act, where the differences will reverse, right, where we have a temporary difference. So remember, we spoke about the two types of differences in chapter 5 last semester. We had a permanent difference, we have a temporary difference, right? So remember, a permanent difference means that IFRS and the Income Tax Act, they treat the item differently, and then they were ever going to agree on how to treat the items. It's a permanent difference. And then we have a temporary difference, and the temporary difference just means that from an accounting perspective and from tax legislation perspective, they treat the item the same. However, there's a timing difference, right? So maybe in 1 year, the item might be recognized in terms of accounting, and in the next year, in year 2, the income tax will then recognize the item, right? So the temporary difference, the item is treated, or the transaction is treated exactly the same. However, timing difference of when they are recorded or charged differs. Right? So let's go back to our total tax expense, right? So total tax expense, it's based on accounting profits, and then we have always calculated using our accounting profits, and it's based on IFRS, right? And then we have our current tax, right? And our current tax is calculated based on our taxable income, and it is based on the tax legislation. So then the difference, so now we can just do like a little easy math solve, right? So if we have total tax expense, you have your current tax, you have your current tax, right? We can calculate our deferred tax, which is saying total tax expense minus current tax will give us our deferred tax, right? That's easy, because if we have our statement of comprehensive, if we have our income statement in front of us, we don't know what our deferred tax is, we can just say total tax expense minus our current tax, we'll have our deferred tax, right? And well, that will be the difference between the two will be our deferred tax adjustment, right? But that is if we have our income statement in front of us. Let's look at a quick example of how we can calculate our deferred tax adjustment using our income statement. Oh my word, if I can get to the Excel sheet. Let's see what's happening here. Okay, wait, let me pause quickly. Okay, so I found the example that I want to show you guys. So remember, before I cut off the video, or I paused the video, I said that we can calculate our deferred tax adjustment by saying our tax expense minus our current tax. Alright, will give us our deferred tax adjustment, and that is if we have our statement of comprehensive income information available, right? And if you see over here, this method of calculating deferred tax adjustment is called the income statement method, because we're using information from our income statement. So the example says APC Limited purchased a vehicle on the 1st of January 2011. So the cost of the vehicle is 150,000. Depreciation, right, for accounting purposes is 2 years. Wear and tear for tax purposes is 3 years, right? Excuse me, both are straight line method. So the profit after tax for each year after depreciation has been taken into account is 100,000. And so the only differences are the ones that are noticed above. Okay. So you are required. We are going to calculate our current tax for each of the 3 years. We are going to calculate the total tax expense incurred for the 3 years. Why are we calculating those two? We're calculating those two because the difference between the two will then be our deferred tax adjustment, right? So we calculate our current tax for all the years. Excuse me. Current tax for all the years, the total tax expense, and then the difference between the two will be our deferred tax adjustment. So we calculate our deferred tax, we calculate our current tax for the 3 years, right? So profit before tax is 100,000. Alright, and to remember calculation of the current tax, we did that in chapter 5 last semester. So you guys should know how to do this, right? You should remember how to do this. So profit before tax, there's no permanent difference. So we have movement in our temporary differences. So remember the 100,000 over here. The profit before tax, this is after our depreciation. So what do we do? In order to convert our accounting profit into our taxable income, we need to add back our depreciation, right? And then we deduct our wear and tear. So for 2011, right? 2011, we have a depreciation of 75,000. Where do we get the 75,000? It's the 150,000, the cost, divided by 2 years. So for 2011, we have depreciation of 75,000. 2012, we have depreciation of 75,000. 2013, we do not have any depreciation, because remember, we depreciated over 2 years. Wear and tear is over 3 years, so it will be 50,000 per year, right? So 150 divided by 3 will give us 50,000. So wear and tear we deduct. Our taxable profit will then be for 2012 and 2011 will be exactly the same, 125,000. And then for 2013, our taxable profit will be 50,000. right? And so so our current tax will be 28% of our taxable profit. 2011 and 2012 it will be 35,000, and then for 2013 it will be 14,000. The journal that we will process in order to recognize our current tax will be debit tax expense, right? So 2011 and 2012 35,000, and then 2013 debit tax expense with the 14,000 over there, and then current tax payable will then be our credit. Right, so there we've calculated, so now we've calculated our current tax for all 3 years. Calculation 2, we need to calculate what is our total tax expense that we incurred for 2011. So our profit before tax is 100,000 for all 3 years. It means that our tax incurred, right, the tax on our accounting profit will be 28%. We get to that by saying 100,000 times 28% will give us 28,000. So our profit after tax, which will be 72,000. So now we've calculated our current tax for both years. We've calculated our tax incurred, our total tax expense. Alright, and so now we can use our tax, our total tax minus our current tax to get to our deferred tax adjustment. So, current tax, right? And so remember, the current tax that we calculated is based on the income tax rules. So, as highlighted over here in yellow, 14,000, 35, and 35. Alright, and then for our total tax expense, calculated based on our IFRS, alright, accrual concept, it is 28 through all the years, right? So the deferred tax adjustment, so you guys agree, we recognize this 14, the 35 for 2011 and 2012, and then the 14,000 for 2013 as a current, as a tax expense. But so now we need to adjust our tax expense to 28,000, isn't it? So for 2011 and 2012, right, we process this journal, debit tax expense, credit current tax payable, 35,000. So currently for 2011 and 2012, in our current tax account, we would have 35,000, right? However, we need to adjust our tax account, or the tax account, or the tax expense account, to 28,000. So what do we need to do? We need to credit, right? We need to decrease our current tax from 35,000 to 28,000. How do we do that? We deduct 7,000, isn't it? We minus 7,000 to get the 35 to 28,000. Same for 2012. After we've processed this journal over here, our tax expense account will be sitting at 35. However, our tax incurred, our total tax expense, right, that should be taken to profit and loss, must be 28,000. Alright, so what do we need to do? We need to decrease our tax expense with 7,000. And then for 2013, we calculated a current tax of 14,000. Again, the total tax expense that must be represented on our statement of comprehensive income should be 28,000. So we need to increase the 14,000 that we have recognized over here, 14,000. We need to adjust it to 28,000. So what do we need to do? We need to add 14,000 over there. Right? And so yeah, I said the adjustment, so this 14,000, 7,000 and 7,000 is the deferred tax adjustment that we need to process, right, in order to adjust our current tax to our total tax expense. So again, a reminder, so over here on the statement of comprehensive income, we need to present the tax incurred according to based on IFRS, right? So we process an adjustment, and that is called our deferred tax adjustment. So on our statement of comprehensive income, we will have total tax expense will be 28,000 through all the years, the current tax 14, 35, 35, and then we'll have our deferred tax adjustment over there.